Bravida Holding AB, a leading provider of end-to-end service and installation solutions across the Nordic region, exhibits significant operational resilience despite challenging macroeconomic conditions in the construction sector. The company successfully executed a strategic shift in the third quarter of 2025, Q3 2025, prioritizing high-margin work over sheer volume. This decision resulted in a 17% increase in EBITDA and a noteworthy margin expansion to 5.3%, even as net sales declined by 2%. This performance underscores the stability provided by Bravida's business model, particularly its substantial reliance on recurring service revenue, which accounts for 48% of total turnover. The critical friction point for the investment case is the company's severely strained working capital management. Q3 2025 saw a negative cash flow from operational activities, CFO, of SEK minus 111 million, a stark reversal from the prior year. This liquidity deficit drove a corresponding 34.5% increase in net debt, which reached SEK 3,469 million. Management attributes this to contractual timing, specifically increased accrued revenues in large projects that have not yet reached invoicing milestones. Resolving whether this divergence between strong profitability and weak liquidity is temporary, project timing, or structural, poor cash conversion terms is essential for the short-term valuation. Bravida possesses a strong structural advantage derived from its dominant market share, 9%, in the highly fragmented CC 319 billion Nordic technical installation market. Its integrated operational framework, known as the Bravida Way, allows for centralized efficiency paired with decentralized local execution. Furthermore, the company is strategically positioned to capture structural, counter-cyclical growth by focusing heavily on ESG-related services, such as energy optimization, solar power, and electric vehicle EV charging infrastructure, aligning with the mandated Nordic energy transition. The analysis indicates that the strong fundamental operational improvements justify a valuation premium relative to pure construction peers. Technical indicators further suggest the stock is oversold, with an RSI 14 reading of 22.16. This oversold signal implies that the market sell-off, driven by liquidity concerns, may be disproportionate to the underlying operational success. If the working capital deficit normalizes as expected by management, the stock presents a compelling entry point. Company Overview and Strategic Foundation. The Bravida Way. 2.1. Bravida's Operational Framework. The Bravida Way. Bravida is marketed as the essential partner providing end-to-end solutions that bring buildings to life and ensure that technical functions operate seamlessly throughout the property's entire life cycle. The company's core technical expertise spans electrics, heating, plumbing, and HVAC in addition to project design. Operationally, Bravida utilizes a decentralized structure, maintaining a local presence through approximately 192 locations across the Nordic region. This geographical breadth is crucial because the Nordic installation market is characterized by small and medium-sized projects typically handled by local actors. Bravida bridges the gap between local agility and corporate scale through the Bravida Way, a unified system encompassing shared culture, values, group-wide strategies, and standardized working methods and tools. This standardized operating model allows Bravida to achieve scalable standardization in a highly localized market. By unifying its processes, the company effectively extracts economies of scale in areas such as procurement, financing, and centralized risk assessment, while simultaneously preserving the customer intimacy and responsiveness of local service providers. This synergy constitutes a significant structural competitive advantage that is difficult for purely regional or smaller competitors to replicate, supporting Bravida's position as the market's primary consolidator. 2.2. Business Mix and Resilience. The 48-52 split, Bravida maintains a robust revenue diversification model, with 48% of total turnover originating from service and 52% from installation.
This high proportion of stable, recurring service revenue acts as a defensive buffer, providing significant insulation against the severe volatility typically associated with the highly cyclical installation market, which is sensitive to new build construction rates. The Q3 2025 performance validated this strategic mix, demonstrating that margin improvement, 17% EBITDA growth, was achieved despite installation headwinds. Bravida's core strategic imperative is centered on achieving long-term and profitable growth, which strictly focuses on accepting only projects and assignments that offer healthy margins. 2.3. Acquisition Strategy, M&A. Inorganic growth through strategic mergers and acquisitions, M&A, remains a key pillar of Bravida's strategy. The company is an active acquirer, having added approximately Sek 391 million in annual sales through 2 companies acquired year-to-date in 2025. However, the M&A process is currently being managed with discipline. Management has noted that transactions are taking longer to complete due to prevailing market uncertainty. This measured approach demonstrates managerial stringency, where capital preservation is prioritized. Furthermore, Bravida explicitly requires that acquired companies add value right from the start. This suggests a stringent financial and cultural vetting process is in place to ensure immediate profitability accretion, which protects the balance sheet from the risks of prolonged, costly, or challenging integrations often seen in rapid M&A roll-ups. 3. Nordic market dynamics and competitive positioning. 3.1. Market size and fragmentation. Bravida operates within a large and fragmented Nordic market for technical service and installations in buildings, which recorded total sales of approximately Sek 319 billion in 2024. The market comprises 3 primary segments: new build, renovation, and maintenance. Bravida holds a leading position in this market, commanding an estimated 9% market share. Competition is defined by localized activity, with the majority of projects carried out by smaller, local actors. Bravida's competitive advantage lies in its ability to offer comprehensive, end-to-end solutions to its 84,000 customers through its extensive network of 192 decentralized locations. Major customer groups include construction companies, industrial firms, property owners, crucial for service operations, and the public sector. 3.2. Competitive landscape and scale advantage. Bravida's primary Nordic competitors include Caverion, a direct rival offering lifecycle solutions, as well as companies like Sweco Group, NCC, Core, and ISS, which compete across various service and installation segments. While Bravida is the market leader, together with a few other large Nordic market participants, they collectively account for only about 30% of the core market. The highly fragmented nature of the remaining 70% of the market validates Bravida's scale strategy. The company's integrated solutions and size allow it to manage complex project risks, such as those inherent in fixed-price contracts, subcontracting, or full responsibility projects, turnkey contracts. This capability creates substantial barriers to entry for smaller firms. Furthermore, Bravida's scale provides enhanced pricing power and superior ability to secure large, multi-regional service work, evidenced by a recent nationwide service and installation contract win in Denmark. The centralized, standardized nature of Bravida's operations ensures that its scale translates directly into efficiency, confirming its role as the dominant market consolidator. IV. Financial Performance Review, Margin Resilience in Downturn, 4.1. Q3 2025 Headline Performance. Bravida's financial results for Q3 2025 reflect a decisive move toward profitability protection over volume growth. Net sales decreased by 2% year-over-year to Sek 6,433 million, down from Sek 6,575 million. However, operational efficiency significantly improved. EBITDA increased by 17% to Sek 342 million, up from Sek 294 million. Basic and diluted earnings per share (EPS) increased by 24% to Sek 1.19 from Sek 0.96. The corresponding EBITDA margin expanded markedly to 5.3% from 4.5%. Profit after tax grew by 22%. 4.2. Analysis of deliberate project selection. The increase in profitability despite shrinking sales volume demonstrates highly effective active management during a cyclical downturn. Management confirmed that the lower sales figures were the result of a strategy of restrictive project selection, which deliberately prioritized margins and minimized exposure to risk in the weak economic climate. This choice to reject low-margin installation projects protected capital and focused resources on higher return activities. This successful decoupling of profitability from volume growth confirms the strength of Bravida's operational control systems and ability to execute sophisticated risk assessments. Segmental strength was apparent, with the improvement in EBITDA specifically attributed to a significant improvement in earnings in Denmark. The margin expansion demonstrates that centralized cost control and leverage of economies of scale are translating directly into competitive operational efficiency, successfully offsetting macroeconomic demand pressures. 4.3. Order backlog quality and visibility. The order backlog remains stable, decreasing only slightly by 1% to 16,381 million.
Crucially, the backlog quality is high, which management attributes to the stringent project selection approach combined with careful customer selection and risk assessment. This high-quality backlog ensures solid revenue visibility for the coming quarters and provides strong evidence that the elevated 5.3% EBITDA margin achieved in Q3 2025 is sustainable, or at least highly protected from severe deterioration as these selective, profitable projects convert to revenue. V. Capital structure, liquidity, and working capital management. 5.1. Critical review of operating cash flow, CFO. The primary area of financial concern is the rapid deterioration of operating cash flow, which registered SAK minus 111 million in Q3 2025. This liquidity strain is severe given the positive cash generation in the prior period. The management explanation attributes this deficit to an increase in accrued revenues in certain large projects. This represents a temporary misalignment in the cash conversion cycle. Work has been performed and recognized as revenue, contributing positively to the EBITDA figure, but contractual milestones for invoicing have not yet been met, thus delaying the actual cash inflow. This working capital strain is critical because it forces Bravida to finance the gap internally or externally, directly leading to the increase in net debt. If this issue persists, it could severely compromise the company's capital allocation flexibility, potentially delaying profitable M&A opportunities or placing pressure on the generous current dividend yield of 4.73%. The viability of the short-term investment thesis relies heavily on the timely normalization of these contractual invoicing cycles in the subsequent quarters to restore positive cash conversion. 5.2. Net debt and leverage profile. Net debt increased substantially by 34.5% year-over-year, settling at 3,469 million in Q3 2025. This sharp rise indicates a growing reliance on leverage, primarily driven by the need to fund the working capital gap created by accrued revenues and sustained M&A activity. While a precise gearing ratio, net debt/TTM EBITDA, requires further calculation, the significant debt increase, coupled with the temporary operational cash flow pressure, suggests that Bravida's financial flexibility is constrained. Elevated leverage levels can restrict the company's ability to aggressively pursue high-quality M&A opportunities and increase sensitivity to future interest rate changes. Until operational cash flow improves, the market will scrutinize this leverage profile closely. Table 4. Key Financial Health Indicators, Q3 2025. V. Valuation Assessment and Price Target Derivation. 6.1. Relative Valuation Multiples. Bravida trades at a normalized price-earnings (PE) ratio between 13.9x and 14.2x, a price-sales (PS) ratio of 0.6x, and a price-book value (PB) ratio of 1.9x. 6.2. Peer comparison and premium justification. When compared against its peer group, which includes companies like Securitas, Loomis, and Core, Bravida trades at a noticeable premium.
Its P/E ratio, 14.0x, is substantially higher than the peer average, 10.2x, and its P/B ratio, 1.9x, also exceeds the peer average, 1.3x. Conversely, its P/S ratio, 0.6x, sits below the sector average, 1.3x. This valuation premium is attributed to Bravida's structurally superior operational model, the Bravida Way, its market-leading position, and the stabilizing effect of its high-proportion service revenue mix. Investors are effectively willing to pay more for a company that demonstrates resilience and scale leadership in a highly cyclical sector. 6.3. Analyst consensus forward-looking metrics. Forward-looking metrics support a positive outlook. Analyst consensus projects robust future earnings, estimating an annual EPS of 7.39 by 2026. Furthermore, the projected stock price of 110.73 GBX suggests a potential upside of approximately 18.94%. This consensus indicates that analysts are largely discounting the temporary Q3 working capital issues and validating the success of Bravida's margin-focused strategy. V. Strategic growth vectors, ESG, electrification, and future demand. 7.1.
Sustainability integration and long-term targets. Bravida has woven sustainability into its corporate strategy, setting aggressive long-term targets. The company aims to achieve climate neutrality across its entire value chain by 2045. Internally, Bravida has committed to using 100% renewable energy in all leased premises by the end of 2023. Externally, the company targets helping its customers cut emissions by 55% by 2030 through its service offerings. 7.2. Tapping into the energy transition. Bravida is capitalizing on the massive infrastructure investment required for the Nordic energy transition. The company's offering includes a heavy focus on low-carbon energy solutions such as the installation and servicing of solar panels, electric car charging infrastructure, heat pumps, and energy-efficient lighting systems. This focus on the green transition acts as a structural, long-term demand driver that is counter-cyclical to the new build construction cycle. As government regulations tighten and energy costs remain high, property owners are mandated or incentivized to invest in renovation and energy retrofitting, irrespective of the broader economic climate. These efficiency upgrades, such as building automation and heat pump installation, provide a stable, predictable, and specialized revenue stream that significantly enhances the overall quality and defensive characteristics of Bravida's services and specialized installation segments. 8. Investment risks and sensitivities. 8.1. Liquidity risk and cash conversion. The foremost immediate risk is the persistence of negative operational cash flow and the associated working capital strain. If the collection of accrued revenues is delayed beyond management's expectations, Bravida may be forced to increase its borrowing further. This would strain the balance sheet, push the net debt/EBITDA ratio toward critical thresholds, and potentially compel a reduction in planned M&A activities, or, in a worst-case scenario, threaten the continuation of the dividend. 8.2. Operational and execution risk. Despite stringent project selection, Bravida remains exposed to execution risks inherent in construction and complex installations. These risks include the potential for cost overruns leading to write-down losses on fixed-price contracts and challenges associated with incorrect revenue recognition processes. Furthermore, the company faces exposure to volatile raw material prices, e.g. metals for plumbing/electric systems. While Bravida's scale helps mitigate this through superior purchasing power, geopolitical and supply chain disruptions can still erode margins on projects locked into fixed-price agreements. 8.3. Cyclicality and demand headwinds. Although the service segment is resilient, 52% of Bravida's revenue originates from installation. This segment is directly sensitive to sustained high interest rates and the resulting slowdown in new construction activity across the Nordic region. A deeper or more prolonged recession would eventually exert pressure on overall demand, potentially leading property owners to defer discretionary maintenance, thereby impacting even the stable service market. Conclusion.
Bravida Holding AB presents a complex but fundamentally attractive investment profile. The company is successfully navigating severe cyclical headwinds by strategically sacrificing volume for high-quality margin, validated by the 17% EBITDA growth and 5.3% margin achieved in Q3 2025. This operational achievement confirms the strength of the Bravida Way model and the defensive value of its service business. The primary investment hurdle is the severe short-term working capital deterioration, evidenced by the negative SEK 111 million operating cash flow and the associated rise in net debt. While management's explanation, accrued revenues awaiting contractual invoicing, is logical for a project-based business, investors require immediate confirmation that cash conversion will normalize to alleviate financial stress.
Bravida's dominant market position, robust structural advantage as a consolidator, and strong exposure to the long-term mandated growth of the Nordic energy transition market, the company's underlying value remains compelling. The stock is technically oversold, and analyst consensus targets imply substantial upside. Bravida BRAV is assigned a cautiously positive recommendation. Long-term investors focused on structural growth and market leadership should view the current technical oversold condition and financial turbulence as a potential opportunity, contingent on the successful, timely collection of accrued revenues in the near term. Close monitoring of the Q4 2025 cash flow statement will be crucial.